You do that over the next 10 years and you're at $1.2 million in income. It's phenomenal. So how do we get there? What does it take to be able to take that first step or that 10th step? Well, let's take a look at this here. So here's a graph. Let me back it up there. Here's a graph. And this graph here is by the Federal Housing Finance Agency, which you'll typically see as FHFA. Okay? This dates all the way back, if you look at the full graph, to 1900. Now, back in that time, you can buy a brand new house for about $3,200. I don't think you're going to find that anywhere around Santa Barbara. You might be able to find that if it had wheels on it, but it'd be a beat-up mobile home. You could pick up properties in certain markets across the states that are still diving down, like in Illinois. In fact, there's a lot of banks that will give you the properties for free. But your markets that offer some value, you're not going to find that. But today, we've seen from 1900 all the way over to 2017, basically a roller coaster, a wave, a ride, where real estate has gone up and real estate has gone down. Real estate has gone up and real estate has gone down. But the one common thing is that it does this. Now, if we take it as a stock market, we won't see these waves. We'll see a lot of peaks and valleys is what we're going to do. And you really have to have the stomach for that, because it's like going on Colossus at, drunk at Magic Mountain. It'll make you sick. But the people that bought and just held, like your great-grandparents told you to do, buy a home, pay it off, buy some rentals, pay it off, are doing extremely well today. I mean, I came across a gentleman not too long ago, and he was a bus driver. He was bus driving in the 60s, 70s, retired in the 80s. Didn't make much money. What does a bus driver make? Hardly anything. However, he's disciplined. He's a disciplined investor. My tagline for my company is a disciplined investor. And he was self-taught. But he would earn enough money to be able to go buy a rental property, and go buy a rental property, and go buy a rental property. Today, he's in his mid-70s. And he's worth $9.3 million by buying small little houses. Buying and holding, and not really ever selling. Just by being disciplined. I think that's a big problem with us Americans, is that we lack a lot of discipline. Because we have to have the newest iPhone that's $800. Or we'll just lease it and pay them $40 a month or whatever it is. Get the biggest satellite package we can get. I mean, money's going everywhere. It's not true enjoyment. It's very instantaneous and goes away real quick, and we're on to the next thing. But if we were to buy properties, and let's say we had a property we purchased at $100,000, this is a compound interest calculator. You can find them online. But if we had a property that's truly worth $100,000, and we had an interest rate of 5%, meaning the appreciation rate. Now, historically, from the Great Depression to today's date, is right around 6.5%. Some will say 6.3, some will say 7, but it's about 6.5%. So I'm kind of being modest here. But if you held this $100,000 property at a low appreciation rate of 5% for the next 30 years, then the value of that property would be $432,000. $432,000. If you had 20 of those, you're now worth $8.6 million off of a simple investment, off of simple numbers. See, a lot of this truly is simple. What makes it complicated is you. Most people just can't get out of their own way. The big F word comes into play. Fear. What would this do for you and your family if you were able to collect $432,000 in equity per property. See, my grandfather, and I didn't know at the time, and he died young, and I was young. I was only 12 years old. He was a pretty big attorney for a lot of celebrities. And I used to go around with him in his car to all these rental properties he owned along the coast, anywhere from Manhattan Beach all the way down to Dana Point. And all of his properties, they weren't houses, they were duplexes or fourplexes is what he owned. He died in his 50s. Heart attack. My grandmother never worked a day in her life. But what did that do for her? It created safety. Think about it. Many of you have parents, you might be in this position yourself. And you may go buy your home, and you pay it off free and clear. Kudos to you. And let's say, for instance, you pass away, and your wife's, now a senior. She wants to stay in her home. But the way the world's going today, money goes quick, and we're not just earning enough to survive. And now we're at a point where she has to move out of her home because she lacks the money. She doesn't have it. What would one rental property do for her? If she had this one rental property that they would have bought 30 years prior to that, it'd be worth $432,000. She can liquidate that property and live out the rest of her life comfortably, just off of one rental property. It's not too late. I don't care how old you are. It's never too late. And then for someone like you, that maybe my age or younger, and you build up to 20 rental properties, don't you want to leave a legacy to your family? I mean, my kid right now is he's in his junior year, but his sophomore year, he's already researching colleges. I wasn't thinking of college when I was in a sophomore year, but he is. And who's going to pay for that? Hopefully they are, because he's going to get grants, or scholarships, I should say. But I may have to pay for that. And what does an average wedding cost today? $35,000. Who pays for that? The father of the bride, right? And so I've got a daughter, and by the time she gets married, and it better be later on in life, right? I'm going to end up having to flip that bill. So you know what I did for mine? I took it a step further. When my kids were born, I bought them each a house. Locked it away. Who cares about what the credit union offers with their Christmas plan or their college fund? What am I going to earn there? Buy them a house. Put it off to the side. Let it cash flow. Even if you've got a loan on it, let the cash flow pay for the mortgage and put that money away. And when it's time for my daughter to get married or my kid who wants to go to college, paid for, and I don't have to worry about it because my tenants just paid for it. Much better retirement plan or some sort of funding plan than your local bank or credit union. $120,000 a year off of 20 houses, producing $500 a month, equaling to be $8.6 million in the next 30 years. Can you even imagine that? Because if you can imagine it, then you're already on your way. See, we have to develop short-term, mid-term, and long-term goals. You have to know what you're going after. Just like that donkey with the carrot in front of their face. They keep walking and walking, think they're going to get that carrot. We got to do the same thing. The difference is we're going to get it, and that donkey will get it right when he's at the end of his journey, right? So we need to start focusing on buying rental properties, whether you're going to do it on your own, or leverage by getting a loan, or doing it in a joint venture, a syndication. It doesn't matter. You have to get it going. So the biggest question that most people have is where are they going to get the money to start investing? Well, a lot of people come to me because they want to learn how to build a real estate businesses. Now, I'm not just a real estate guy. I own 5 full-time businesses. I'm a business owner. Real estate just happens to be one of my favorite. But a lot of people come to me to optimize their business. They come to me to learn how to build a business. And a lot of them come to me to learn how to flip properties. I speak at a lot of real estate clubs, and they always say, you want to talk about wholesaling? Because everybody knows I'm the wholesaler. I don't care. You pick a big, large organization out there that teaches wholesaling, and I guarantee you, one of their teachers is my student. In fact, do you guys ever watch Flip or Flop? You know, the couple that just flopped? Well, they're trainers. Some of their trainers, my students, for flipping properties. So you can generate income through assignments of contract like Dan was mentioning earlier. You can do it through double closings. In fact, has anybody ever heard of a double closing in here? Fantastic. Okay, so can you do double closings, by the way? Yes or no? Yes? They're not illegal? No, they're not illegal. Neither is assignments. So let me tell you something, because this is fresh in my mind, just happened yesterday. I closed 2 transactions yesterday, okay? I got presented an opportunity that I couldn't say no to. Has anybody ever heard of home investors? Home investors brought me 2 properties, and they had quite a bit of equity in it. Not a grand amount, but enough to make everybody happy. So home investors is out there doing all their marketing. They pull in 2 distressed owners that want to sell their property. Home investors puts it under a purchase and sales contract. Then they package up the marketing, they bring it over to someone like me. They say, hey, Sensei, you interested in this property? I said, no, I'm interested in both. In fact, if I buy both and I can close on both of them, will you give me a better deal? And they said, absolutely. It's like, great, quit taking calls, we'll take them both. Now, they said, we're going to assign you the contract. You must close on these deals. You can't assign it out because they know I'm a wholesaler. I said, no problem. I will close on these deals, meaning that I will come out of pocket and pay for the properties. No problem. Now, I have a decision to make, guys. Do I buy these properties, swing the hammers, fix them up, and sell them retail to get paid 6 months later from now? Or do I wholesale them out? Well, they just told me I can't assign it out. In fact, they put in their assignment contract, this contract is not assignable. So you know what I did? I double closed it. I already had buyers lined up. So picture this, guys. We have 4 parties, right? A being the distressed sellers, B being the wholesaling firm, home investors, C, black belt investors, and D being my cash buyers. Distressed sellers, put it under contract, go into escrow with home investors. Home investors turns around and assigns the contracts over to me. I bring in my cash buyers. I use a dry double closing. I close out both of them. Not 1 red cent came out of my pocket. Home investors made $9,000 each per contract. I made $10,000 on one contract, $13,000 on the other. What did it cost me? My time, my education to be able to do that.
Did you sell it to investors?
Yeah, my investors. Now, I got an extensive cash buyers list. I said, hey, boom, here you go. And you know what? It becomes a win-win-win-win situation. Distressed owners got all the burden off their back. Home investor walks away with 18 grand. I have 23 grand, and my 2 investors are swinging hammers starting next week, fixing up a property. And all I had to do is pull money out of thin air. Shuffle paperwork. See, when they tell me you can't do something, remember I said about the gray area? I'm not going to do anything illegal. We'll just bend the rules. Everybody's happy.
You're not a real estate broker, or are you?
I've never had a license in my life. Okay? Not that it would have hindered me from doing that. I can still do it. But it would hinder me on the purchase option side because I do a lot of subject to transactions and lease options. That would hinder me. But we can get the money through wholesaling. We can get the money through buying, fixing, and flipping. We can get the money by acquiring another job if that's what you wanted to. Or tap into your savings or tap into your retirement accounts where you're not earning any money anyways. So there's 6 places where you can find money. Possibly under your mattress. A lot of my investors have a lot of money that's just stored away. Not doing anything with it. Some have it in savings account. What are you guys earning in your savings account? Because I have no idea. What does the bank pay today? 0.2%? So you're earning, ooh, wow, that gets me excited, right? You're not really earning 0.2%, are you? Because then you got to factor inflation, deflation, and tax. So you're losing money by having money sitting in the bank account. That's ridiculous. Why do that? You know the busiest people out there today are your IRA and retirement custodians, because the baby boomers know they're not making any money in their retirement accounts. And so they take that money out, they they shuffle it over into a self-directed or a solo 401k, and now they have the rights to go invest and have everything tax deferred. Dude, that's huge. Because you know why? Because those baby boomers are the ones that got kicked between the legs during the recession, and now they got to put their retirement on steroids. And they know the safest and the most profitable way to do that is through using real estate as that vehicle. You have existing equity, tap into a HELOC, home equity line of credit. We've got a lot of investors that use home equity line of credit because they're so cheap. Money is cheap today. I used to work at Bank of America right out of high school. And I was a teller, then I started doing loan origination. You know, back in the later 80s, home loans were going between 18 and 22% on your primary residence. Does anybody remember that?
Yep.
That's insane. And you know what? People were just signing up to get those loans, weren't they? And then people complain today, well, I'm an investor, I got to pay 5%. 5%? That is so cheap. Where are you going to get money for 5%?
But house prices were cheap back then.
Really? Because that was the top of the market at that time. It was very expensive back then at that time of the market.
Yeah,
And then in 1990 we had a crash. And it doesn't matter because their income could not catch up to the value of the properties anyways. It's still expensive. Because if properties were cheap back then we wouldn't really have that recession in 1990 because people wouldn't have got hurt in real estate. But they did. Lost deposits, lost equity, had to foreclose. Remember that? Remember I said I bought a house in 1995 with my wife? That was a notice of default, a reflection from that recession. It's all relative. I don't care what time of year you're in. But we've got equity we can pull out of your primary residence possibly. But you only pull out enough to where you know you can make that payment. Don't overextend yourself and find yourself underwater. Maybe you got a second home. Where else can you find equity to pull money out of? Maybe you own a car free and clear or a boat. You can always take that back, pink slip back, and get a loan against it. There's lots of ways you can find equity. Creative structuring. I love this. Because here we can do joint ventures and syndications. We all partner up. Maybe we buy a $100,000 house and there's 4 of us and we all kick in $25,000 each. We now own the house free and clear and we don't even have to borrow money. That now makes us safe. A lot safer than being on the hook for a loan, right? So creative structuring is a great way to go. Loans and lines of credit. That's why it's important for me to have a business so I can establish corporate credit. So lenders out there are becoming a little bit more flexible today, and they're allowing businesses to take lines of credit. You can put it against your business, you can take it personally, doesn't matter. There's money out there, you just need to search for it. Or you can just go out there and make more money of it. So let's kind of break this down. So I talked about the retirement accounts, right? You got our 401ks, you got your... here's the cool thing. This is what I love about leverage. Has anybody ever had one of those retirement accounts where if you work for your employer, you put in $1, they'll match $1? Does anybody remember that? That's pretty darn good, isn't it? It's really good. Okay. Think bigger. Bank of America says, you're a real estate investor? I'll tell you what, you put in $2, we'll put in $8. Right? Because as acquiring a loan, you got to put 20% down, and they'll pay 80% of it. Think of it that way. Right? That's leverage. So the less money we come out of pocket, the less risks we have. So tapping into retirement accounts is a great way to go. Equity, I explained. Creative structuring. Let me break this down a little bit here. So I love joint ventureships. And syndications, the same thing. Okay? Syndication, joint venture, it's all the same thing. It's an equity share. And so we can do this on a small property, whether it's a $50,000 house or a $500 million, subdivision. Doesn't matter. The technique, the mechanics all basically work the same. So if we had that small house of $50,000, then maybe I can get 3 of us to kick in $20,000 each. We buy the house free and clear. We have $10,000 in reserves for any vacancy repairs or anything like that. And we just collect the cash flow. I've got an apartment complex right now, which I'm thinking about doing a syndication on. Be a $100,000 buy-in in Cleveland. 80 units. It'd be a $100,000 buy-in. And everybody owns a piece of the equity. And then myself would be the project manager on that. Or maybe, guys, think about it this way. Let's say, for an example, you get a couple people that are hardworking, don't have a whole lot of money. There's a $100,000 property. It's a true value. It cash flows. You hold a little meeting at Starbucks with these investors. You get each person to kick in $20,000, except for you. You put no money into the deal. But those 5 put money into the deal. But you're the legs. You're the eyes. You're the brains. You're structuring everything. You're managing it, and you take a 10% cut. Now you own 10% of that property. And how much money do you have into this deal? Nothing. How many of those can you do? It's all up to you how many you can do. It's just understanding the basic structures. Taking the education and making sure that you have a mentor on your coach. I've got students and myself doing this all the time because I don't have all the money in the world. I'm not that great big rich guy. But I can get a little slice here and a little slice here and a big slice over here. Sometimes it's going to cost me some money. Sometimes it's not going to cost me anything. There's no investment involved. It's the knowledge base that people rely on. It's the management. Because most people in here, most people out there, I should say, don't have the time to go learn about real estate investing. They don't have the time to go find deals and manage teams and all that other great stuff. That's why I love creative structuring. Lines of credit I talked about, making it. Choosing the right rentals. Now, as a landlord, that old adage that's very important, that's 3 words, is what?
Location.
Location, location, location. As a wholesaler, it's the deal, the deal, the deal. I want both. I have to have the location, I have to have the deal. Location matters because that will dictate what your future value will be on that property. It'll also dictate what your rents are going to be. It's going to dictate the exit strategy that you need. It's going to dictate the vacancy factor, so location is going to be key. But earlier I said we make our money when? On the purchase. So I got to combine those two. I'm a wealth builder, not a buy retail side type of guy. So we've got to choose the right rentals. Now Zig Ziglar, I don't know if you know of him, but I'm sure almost everybody does. He says this: success occurs when opportunity meets preparation. When opportunity meets preparation. So what he's basically saying here, there is no luck. Luck is for people that don't know what the hell they're doing. That's luck. Opportunity are for those that do know what they're doing. Now, does that mean you have to know everything in real estate? No, I don't know everything in real estate. Dan doesn't know everything in real estate. I'm just really good at a certain couple niches. Same with them. But I prepare myself to keep my eyes and ears open to quickly evaluate to figure out if it's an opportunity or not. And it's important when you come here, guys, to this meeting, that you don't sit in these chairs and act like it's a library. You get in here and you start shaking hands and meeting each other. You have no idea who you're sitting next to. They could be dead broke, but they may have a wholesale deal and don't know what to do with it. And you could be sitting next to a millionaire that doesn't want to do any work but wants to loan money. How do you know unless you're networking? That's what this meeting's about. Get off your assets and start doing something and prepare yourself so that you can take the opportunity. Now, I'm in several different markets. I've got a service called Remote Rehabs, which I've been offering since the year 2000. And I help investors like yourself go from point A to Z. I build millionaires is what my job is. It takes time. It's not a get-rich-quick scheme. It's going to take some time, but it can happen. And I'm in select markets. In fact, to my knowledge, I'm the second oldest company in California that pipelines out-of-state investments here. Been doing it since the 90s. And so I'm in these different markets that I have selected throughout the states, and every once in a while we'll change up a market. But today I'm going to talk about Cleveland and why I love Cleveland. Well, Cleveland, I went back there in the early 90s, and I went through that town, and I said, this place is an armpit. I will never come back. It's terrible. It's a twin sister of Detroit, meaning that Detroit is automotive. And Cleveland built all the automotive parts. Like I have a 1970 fastback that I'm just finished restoring. It's a 351 Cleveland, right? So they supply all the automotive parts. When Detroit goes down because of recession, who follows suit? Cleveland. They can never get themselves out of the hole until about the year 2009. They start doing things different. Cleveland today is becoming a mega empire, and people just don't know about it. But they're starting to get a taste now. We have LeBron James, right? 2016 NBA champions were in the NBA playoffs this past year. We've got the Cleveland Indians. We're in the World Series this last year. So we got the two top teams. Oh, let's not forget the Cleveland Browns, because they are absolutely the worst football team in the NFL. So they all have their rankings, don't they? But if you don't know what this is, they just built the Rock and Roll Hall of Fame right on Lake Erie, which would be right over here, actually, behind those buildings. Who's got the most Broadway shows in America? Broadway shows?
Broadway.
Where is that? New York. Cleveland has number 2. Yeah, people don't know that. Huge industry there. And then the biggest factor why most people are capitalizing on the opportunity there is Cleveland Clinic. Cleveland Clinic, we can be hearing, watching Tom and Jerry cartoons, the next thing you know, Cleveland Clinic commercial comes on. World renowned. The medical industry is extremely big over there. In fact, it's the number 1 spot in the United States. If you take a look at the top 50 hospitals and medical clinics in the United States, Cleveland has 16 of them. So who moves there? Millennials move there. Who else moves there? The baby boomers that need the medical attention. So they're going through a huge growth spurt right now. So let's take a look at some of the growth. It is definitely the healthcare hub with over 60 hospitals and biomedical industry. In fact, on the biomedical side, they have over 600 facilities in the Cleveland area. Cleveland is now, right there, as I mentioned, fastest growing healthcare economy in the United States. Does healthcare get smaller or bigger, by the way?
Bigger.
Bigger. You know what, guys, you don't have to write this down. You just go to my website. I got all the statistics there. It just gets bigger. Now, this just came out 2 weeks ago, guys. I love this. Forbes. You guys ever read Forbes? You should. And Forbes says this: Cleveland is one of the strongest markets in the nation, offering investors high cash flow and future growth. With a workforce of over 2 million people, Cleveland has the 12th largest economic region in the nation. I'm going to stop right there. Because if you remember watching the RNC last year, it was held where? In Cleveland. And the governor, John Kasich, was talking about how Ohio was the 47th and 48th worst economic state in the United States. But today, they're number 8. Really? You gotta ask yourself the question, why? The number of people moving to downtown Cleveland has also gone up 32% from 1990 to year 2000, the largest population increase of any Midwest city, including Chicago, and far above the regional average at 7.7%, according to Brookings. Forbes also says, and the pace is picking up with with an all-time high of 12,500 moving downtown just last summer, mostly comprised of coveted millennials. The demographics have shifted, referred to the brain gain, since there's been a 139% rise in the number of young residents with a bachelor's degree. Interesting. We're going from old steel industrial age to very tech age is what we're doing here. Why downtown Cleveland has experienced a renaissance over the past 5 years? with an estimated of 19 billion in development completed or planned since the year 2010. Now, since the year 2010, they were only planning to do 7 billion. They didn't expect the influx of growth. And now they're up to 19 billion, widening freeways. You only widen freeways for one reason: to handle traffic.